instruct you about the basic subject of technical analysis. I'm very glad and full of gratitude to ElearnMarkets.com for helping us, portray our knowledge through their portal. And essentially, this webinar, this session is to discuss more about the subject per se and on using the Spider Iris software. We have used this software. I personally have been using this software since 2004, 2005. And we've used this software per se to demonstrate the subject and the charts. However, this is not a recommendation to buy or sell any financial instruments, but rather guidelines to interpreting the using specific indicators, etc., which is there within the software. This video is completely educational in nature and it's not recommended for a buy or sell of any financial or any other asset class. Okay. Now, to move forward at any point of time, if you have any doubts to ask me about a particular slide or anything to do with the software, you can unmute yourself, as Vinit said some time back, and we can discuss on that. Moving forward with what the subject is and what are the basic tenets, etc. I will be toggling between the presentation as well as a basic chart. And now this is the NSE Nifty spot chart on the Iris software. If you are using any of these softwares, they'll generally open in a black screen. I prefer the white one, so you'll probably find it a little different, but it's the same chart per se. So this is what I'll be doing, rather than you have the basic subject as in what the presentation says with you. So I'll be just rushing through them. You can ask your questions, and I'll actually, more intention is to show you the practicality of the subject as in the charts. So the subject essentially is a study of the past market data. So I'll just show you that this is a chart, and I'll, for the time being, just hide the moving averages because that's not the need of the hour. So this is essentially a two-dimensional picture. In one axis we have time, that is the horizontal axis, and on this axis you have price. So what we have in front of you, be it a bar chart or a line chart or a candlestick chart. Now how I'm doing this is just few hotkeys. If I type B, that is for Bombay, it becomes a bar chart. If I type L, that is London, it becomes a line chart. And if I type J, that is the month of June, it becomes a candlestick chart. Now, the intention of such webinars is, yes, to brush on the theory also, but to know more and you understand more about the software and the practicalities of the trading process. So essentially, technical analysis is the study of the past data. So what we have in front of me, I'm just zooming and zooming out of my chart. This is, if you just type the minus or the plus key on your keyboard, it will zoom in. I'm zooming in and I'm zooming out of my chart. So we have past historical data, and with the past historical data, which is essentially price and volume, which is essentially the most core, the key factors that go into understanding the demand and supply of price. The idea is to analyze where price stands and what is the possibility, probability of the trend extending on the upside or down, and accordingly take a trade with a favorable risk-reward ratio in our favor of this. So that's what in its core technical analysis is. Now, how do we interpret this chart for a buy trade or a hold trade or a sell trade? What all goes into it? A lot of indicators, tools, oscillators goes into it step-by-step manner. That is the intention of the subject overall. But there are a few basic principles, and these basic principles are the core foundations on which the subject is actually standing. And this is the fact that the price tend to move in trends. Okay? And these trends or prices are solely determined by demand and supply. I'll just brush to the third point and show you exactly what I'm trying to say on the chart, is that trend reversals are caused due to shift in demand and supply. Now let's say I go back to my chart. You'll see that on the right hand side corner of your screen there will be a small window which will show you the periodicity of the chart that you're viewing. Now currently I'm viewing the daily chart, DLY. If I want to view the weekly chart, I can click on here and click on weekly. It becomes the weekly chart of Nifty. Now there are obviously hotkeys to do this. If I type on D, it becomes a daily chart, W for a weekly chart, then I type on M for the monthly chart, and so on. So the fact of this subject is the sense that, let's say I have opened the monthly chart of NSE Nifty, and it shows the historical data since the first day. I'm looking at data from November 1994, and it shows the entire data of that index till date. If I do Control V, I have a small little window that comes on to my right. So if I keep my cursor there, you can see the last bar and its date, open, high, low, close. So this is a long-term chart. I can drill down to a weekly and a daily. And if I come down to I, it will give me an intraday chart. This is a tick-by-tick chart. I do Control I for this intraday bar. If I do 5, it becomes a 5-minute chart. Now, what I'm trying to say is no matter how big the time frame, it can be monthly or it can be I, let's say a 5-minute chart. What is obvious in all these charts is the fact that there are trends. You have a downtrend, that's a steady drift of prices coming down. You also have an uptrend, that's a steady drift of prices going up. And obviously there are those volatile trading ranges, which is there in a 5-minute chart and which is also there in a monthly chart. So these drifts, steady drifts on the upside, which leads to that uptrend, or which we call a bull market. The other side of the coin is the steady drift of prices coming down, which we call as a bear market, essentially influenced by demand and supply, nothing more. The price, what we have is essentially the demand and supply that leads to these trends. And the trends are not here forever. Say if you have a nice bull market, if you remember till the end of 2007, they tend to reverse. The idea of technical analysis or any smart trader is to ride the trend, or even before that try to understand when a trend change is happening. So if I go to the mid of, let's say, Jan 2002 or the early 2003, our intention or our work will go into to understand when this trading zone will turn into either a downtrend or an uptrend. Let's say if it's an uptrend, we would like to capture the maximum out of it and try to ride it as much as possible. Probably when I say make the maximum out of it, means that you obviously will have a trailing stop loss, etc. Those are all trading strategies that we will learn slowly in our successive webinars. So the idea is to understand the play between demand and supply, and how this demand and supply is leading to these trends, an uptrend or a downtrend, or sideways trends. This is the chart of Nifty daily and the monthly, which I was showing you on the software. This is the 5-minute chart also. So what are the basic types of technical analysis? They're essentially a predictive and a reactive type. Now, a predictive and a reactive, as the simple word suggests, is the predictive type of technical analysis would try to predict the price, and the reactive type will more react to the price that has already happened. So what does it mean in simple language? Okay, I'm going back to my Nifty daily chart, and without using anything, let's say a basic of a trend line or a basic of a moving average, if I just show you this chart, if I show it to a student who is a fifth standard student, can say that prices are going up, or the bars or the little lines, whatever there on the screen, are slowly drifting up. So you don't need any fancy tools or any fancy mathematics, but you can just view it, because a picture is more than 1,000 words. We are in an uptrend. Okay. Now, a reactive technical analyst would react to such price movements. If prices have already moved up, then he will react to this uptrend, probably going long or probably buying into the market. The predictive technical analyst will probably use the same chart to predict how far can it go and from where probably the trend reversal will come. Now, for those who are new to the subject and those who are in the basic phase of understanding the subject and how it works in the market, sticking to a bit to the reactive side is better rather than jumping into the predictive one. Yes, there is a predictive nature of the market. To some extent, one can predict with some degree of probability where the market probably is likely to face some supply and it will come down. But to start off with, I will always advise stick to the reactive type, and slowly as you learn to introduce your skills to the markets, you start making and losing a bit of money and get a hang of how the trading as a business works, then you can start, it will happen automatically to you that you can start implementing those predictive tools. Both are there. And okay, now few basic theories about the difference between the fundamentals and the technical analysis. This is a little graph that I have on fundamental analysis. A fundamental analyst actually that does a lot of work where goes into the auditor's report, the profit and loss statement, etc., etc., the dividend records, the sales data, the plant capacity. So essentially what a fundamental analyst does, and I've definitely worked in houses like ICICI Securities and Brick Securities where they had a fabulous big team of fundamental analysts, is they are more keen to understand or analyze the sector and the company per se. They want to understand, let's say, an example of, let's say, a steel company, let's say Tata Steel. So a person who is analyzing the steel sector or the stock is more inclined to understand what the company is doing. Now, if I compare that to technical analysis, what technical analysts would do for Tata Steel is we will try to understand the market action. Okay, we'll try to understand the price and volume. So in a very simple layman's word, if I have to say the basic difference between fundamental and technical is, fundamental is all about the company. Okay, is it a good company or a bad company and things like that. Technical analysis is more about the stock, and there's a big difference between the stock and the company. What I'm trying to say is, you can, let's say, open any chart. Let's say I open, as I was mentioning, Tata Steel. Now, how am I doing this? For those who want to understand and learn the software, if I type the hotkey C, it opens a small window, says script by name. Okay, you have small two little windows here. On the left-hand side, if you click on this one, it gives you a drop-down where there are various exchanges. Now, let's say I go to NSE Cash, and over here, let's say I type TATA, and I hit enter. It will give me all the stocks that's listed and traded under NSE, which starts with the letter TATA. Okay, so I can just scroll down and I find my stock, Tata Steel. Code is 3499. Here it opens. If you click on the index, the chart becomes NSE Nifty. Okay. Now if I do 3499, by default it will open the chart of Tata Steel. Now what I was saying was, the difference between the stock and the company is, let's say at this point of time, let's say you have a big fall. I'm looking into a little historical data and see Tata Steel at the point of Jan 2013 was trading at a high of 439.40, and it had a vicious fall to the last fall, that the major downtrend that the stock had gone all the way down to the level of 196. Now what I'm trying to say is, at this point of time, obviously some fundamental triggers might not have come which led to the entire fall. What generally happens is the news obviously comes a little late. The price starts to react much earlier. So there's a difference between the company, the way the company is moving forward. Is it showing a growth path, or it is not in a growth path, or it's just plateauing out? The other factor is the stock. The stock moves and it actually price trades every day. The valuations or the company P&L or the profit and loss don't change 3%, 5% every day, right? But a stock can. So that's where the main difference is. Which is demand and supply. And fundamental analysis is about the company. I would request to please mute your mics. One mic is switched on, so it is good if you all I request to please mute your mics. I'll hear some music in the background, so it's for your benefit. Yeah, thank you. That's good. Moving forward, I actually said a little about one important rationale of technical analysis, that is market action discounts everything. Now, this is a very important, intriguing thing about the subject. This is one rationale which intrigued me a lot when I first started studying about technical analysis and the market in late 2003. What it's trying to say in simple words, market action discounts everything. And I'll stick to my example of Tata Steel, or it's better I go to Nifty. Now let's say I am going back to the past. How I'm doing this, I'm just hitting the left and the right keys on my keyboard. So I'm going to the left of my chart, which is back in the history. If I do right, I'm going in the front, the right side of the screen. So what I've done is I'm coming to my left, and I straight away go to the last bull market top, which we had in 2007, late 2007. And this was one vicious fall that we had. Now, what I'm trying to say is, at this point, at the bar of, let's say, 8th January 2008, when Nifty Spot was hitting a high of 6357, everything was rosy, everything was fine, fundamentals were strong. You hear anything on the TV or the newspaper or interviews in these flashy magazines, people were giving very high targets on the upside. Everything fundamental seems to be very strong. All of a sudden, in just a matter of, let's say, 9 days, the market from a high to low basis was almost down more than 30%. Wow, now how can that happen? Like, why did that happen? So there'll be obviously reasons behind it, but the reasons obviously will come later. So what happened was, you had a start of a bear market, or market topped out here, and the market bottomed out over here. That was the October 2008. So from this low to this high, from this high to this low, beg your pardon, they have been trading days throughout, and there will be flow of news. Now what you'll notice, if you've been there in the market, that the news flow have been started to deteriorate somewhere here in this range, subprime and etc., and we are in a major recession worse than the 1930s, etc. will all come over here, and they not all come, but they have come, not at this point. So what I'm trying to say is, price acts first, news tends to react. It's not that on this day the subprime or some recession, something came on the news that, okay, we are not going to hit a recession, so the market comes off 50%. No, it doesn't happen that way. Market price always acts first. It's a very smart thing. It always acts smart. Then you'll have the news. This is something that is very important, and we should all keep in mind. Let's come down to a very recent example. The very recent example is the fact that the markets have been in a range in the months of November, December, and a little bit of early Jan 2004. The market starts to pick up strong, okay, all the way till here. Not much, but yes, the anticipation of the change of government is obviously there, and then you have a big move. What I'm trying to say is, the market acts or reacts to a foreseeable news, favorable or unfavorable, much beforehand. Now we have very strong, let's say as we speak today on this Saturday of 29th of September, 30th of September 2014, we have strong GDP numbers which have come up last evening. The market already is trading at a life high. Now we would expect that here probably the market will continue to ride, move forward. So it won't be too surprising to see, I'll have to see that what happens next week is, yes, the market will probably show some resilience and strength, but whether it will follow through or not, because a lot of it has already been priced in. You can see the move that it has given in the last minute. So market action discounts everything. This is something that everyone who's trading into the market has to keep in mind. In fact, my experience and my experience with talking to fellow traders in the market are, the news or the media can say something else, but those who trade into the market in a serious manner and those who trade for a living, people like us, price action or what the price of the market is saying is the ultimate. Price moves in trends. That is something that we have spoken about some time back, and we have seen in different time frame charts like a 5-minute or a quarterly month. Prices mean any time trends, and history tends to repeat itself. As if there's an ebb and flow of the prices which we see all the time. Few criticisms of technicals is the fact that it's a self-fulfilling prophecy. What does it mean? It means that all of us in this webinar have probably gone through the same theory, etc., and we're seeing the same chart on the same software. And let's say I see a nice movement, a breakout in the Nifty in the month of Feb 2014. It's given a nice breakout and one should buy. The point is, if we are all reading the same theory, understand the same theory, looking at the same chart, isn't it that we all will act in the same manner? And anyways, the theory will fulfill itself, self-fulfill itself. The answer is probably a lot of extent no, because the fact that yes, we are reading the same stuff, yes, we are looking into the same chart, but how we react to it is going to be very different. And it's been my experience, I've done a lot of experiment with that also, is that if I give the same chart to a bunch of 12 people, 6 of them probably will come up with a buy trade and 6 will come up with a sell trade, irrespective of the fact that they have read the same theory, irrespective of the fact that they're seeing the same chart.
The 14 batch.
So what I'm trying to say is the discretionary nature of the trader.
अगर हमको कुछ बात करना है तो हम कैसे बात करें? क्योंकि मैम हम एक बार बात करने गया तो उधर बोल रहे 12 people are already waiting. हम जब नहीं उधर जो
technical is only short term in nature. Okay, I'll just hold for some time. If someone is talking.
मैम आज जो टेक्निकल जो वेबिनार जो चल रहा है ना अभी, तो उधर पे हम जब करने गया था, कॉल करने गया था, तो हमको दिखा रहा है 12 people are waiting, देन दिखा रहा है मैम अभी जो बैच चल रहा है ओरिजित आरटी ERI हाँ मैम हम बोल नहीं मैम कनेक्ट तो कर लिया, पूरा सुनाई भी दे रहा है, सब कुछ क्लियर हो रहा है, मगर जब हम कॉल करने जा रहा है तब उधर पे दिखा रहा है
okay. So
हाँ मैम
okay. Sorry.
ठीक है.
No, I don't sense as much background. Okay, going forward. So the other criticisms of technical analysis is the fact it's short term in nature. A lot of belief is there in the market that technicals is only for the short term. Going back to my chart is technicals is more about a one-day trade or a one-week trade. Yes, technical analysis is a very good tool to time the market. Let's say the current stature of the market is such that we all know that probably we're in a new bull market and it's going to last for another 3 or 4 years, and you should buy and hold. But let me show you what happened in the large bull market. I've just gone, I've just added W and gone to the weekly chart of Nifty. I'm doing the left arrow on my keyboard to show you the last bull market. Now, this is where it started in May 2003, and you had a nice run towards the end of 2007. Excellent bull market, raging bull market. But the fact is, very few would have bought here, and those who have bought here, very few, and I doubt anyone would have sold here. It's next to impossible. What I'm trying to say is buy and hold works well if you have bought in the middle of a bull market and managed to sell off. If you see other markets like the Japanese market's been in a very severe bear market for a long time. So let's not make any assumptions in the market or in life per se. Assumptions seems to be quite dreadful in nature. So even in a bull market, there are vicious sell-offs which lead to buying opportunity, and at the top, which leads to your chance to book some profits if you've bought early in the trend. So to a lot of extent, technical analysis is a great tool to time the market. Yes, it is. It's a fact. But it is not just limited for short-term trades. One can definitely use technical analysis for longer-term trades also. You've seen people doing monthly chart analysis and finding out targets for the next couple of years. Looking into the monthly chart, which I have just showing you right now, there's a pattern in this chart, and if the pattern plays out well, the Nifty spot has a target on the upside towards the 10K mark, and it's not actually too far off, is it? It's just too
muted. Unmuted.
Price action be used to predict the future? To some extent,
muted.
Yes, because the past price action is essentially made up of demand and supply, which comes from the psychology of the traders who are there in the market. The psyche of the traders never change, right? So, be it 100 years back or now, the main objective of people trading in the market is to make money. When that doesn't change, the price behavior that we see, the ebb and flow of prices going up and lately coming down and making a new high, etc., will never change. It will be a little different in nature, but the main core psychology never changes. Okay, before I go into price plotting price over time, any doubts? Anything anyone wants to ask me about the software or the subject? Okay, please. Yes, I have one question. Please ask.
Morning, sir.
Please ask. Yeah, I can hear you.
Yes, sir. Actually, if we don't actually know when the uptrend has started and when it has ended, then how do we determine our entries and exits in the market?
Okay. So, how do we determine the entries and exits in the market is a second step. The first step that goes into the analysis. Let's say, I'll give you an example that will be a much better option. Let's say I open a chart which I know is probably, so I open the chart of Coal India, okay? Now the purpose why I opened the chart of Coal India is because of the fact that I know that the price of Coal India has been coming down for some time. Now at this juncture, at the last part, the left does not matter anymore much, right? Because what happens is over here. Now what will the analysis say? To answer your question, very simple. First level, first tier of analysis is to understand the trend of the price. Without any fancy tool, everyone probably will agree that the trend is down. So the second question that comes up, is it going to stay down or is it going to reverse? That is the analysis that a technical analyst will do. After doing our analysis, let's say we decide on after we do our work, we say that the possibility is high that it may reverse and go up. How do you come to that point, sir? You say, oh, obviously, let's say if it goes above the 370 or the previous high, which was 372, this downtrend probably will reverse and move up. Now, when you have such a conclusion that yes, the trend will reverse and move up, then the question comes of entry and exit. Okay. Now, at this juncture, let's say the analysis is like this. We are looking into the daily chart and the previous high was 372. If prices takes this high up on the upside, the possibility is there that this price will probably go up further towards the previous high to that, which is 393, and can probably go up further towards 403. If that happens, then I can time my entry, which can be 375 or in the range of 370, 375. I can time my exit close to the 390 mark or the 400. A lot of traders, naive traders, focus a lot into the entry and exit. Now, this is a very important factor about the market, is the entry and exit gets you in and out of the market, but that's not the most important thing. The most important thing is to understand the demand and supply play of prices. Entry and exit can be done at any point of time. So if we all pour in a lot of emphasis on the analysis, we can make fewer entries and fewer exits, but more accurate entries and accurate exits rather than random entries and exits. Okay. So to enter a price, we have to first analyze the chart. After that analysis, what the analysis is telling us, is it a buy or a sell? Then we'll time it. That's the entry. Right. Plotting price over time I've shown you many charts. Okay, I have a question asking, does technical analysis work on penny stock? Let's define a penny stock. Penny stock is something which is illiquid in nature, relatively illiquid. Now, if I open the chart of large cap stock, let's say Reliance Industries, you will see on the right, on the bottom, I have a dark blue histogram, which is the volume. It shows the quantity of shares that's been traded every day. So it's LK is lakhs. 36 lakh shares that have been traded. So that's the volume. The penny stock is something where the volumes are very low. My answer to your question would be something like that. Technical analysis in penny stocks will not work at an efficiency at which it will work for an index or a large cap stocks. The simple reason behind this is the penny stock is relatively illiquid, and so it is very easy to move the prices. If someone, a big fund or a big trader in the market with large volumes can actually move the price vis-a-vis a Nifty or a Reliance or a Tata Steel or a large cap where you need a lot of funds to move the price. So in a penny stock, your own buying or your own selling impact prices, which may not be the case for the index. So where there is a lack of true demand and supply, see, buying and selling essentially is the sides of demand and supply. So in a penny stock, the degree of demand and supply is relatively much lesser
than the demand of supply in Reliance. By demand, degree of demand and supply, I cleanly mean the sheer amount of or the number of players which are there in the market. So, simple answer, technical analysis to a lot of extent, simple rules may not work that well under very illiquid penny stocks because of the nature that they are so illiquid, and a simple bout of buying or selling can lead to spike movements on the upside or on the downside.
Okay. Does technical charts more effective in short-term basis than in long-term basis? I would say that they are effective in both. Technical analysis is a very good timing tool. Okay, you can time it in a 5-minute chart also, and you can time it in a monthly chart also. There are ways that we do that. So it can be said that it's more effective in a short-term basis than long-term. The fact is like this, more psychological in nature. So when I'm saying that the Nifty target on the upside on a long-term chart can be 10,000 on the upside, now from 8,000 to 10,000, it might probably go a little bit up and come down to 6,500 and 6,000. It's a long-term call. It will take some time to play out. But on the short term, a technical chartist or an analyst has very short term to prove himself right or wrong. In a long term, it will take time. It's more psychological. But the answer is they are same effective. It's nothing like technical analysis is more effective in short term than in long term charts. Right. Okay. Going forward, I'll just brush through the basics of the types of charts that we have done. What is TDD? How it is calculated? Can you elaborate a little bit more, Akash, on your question? Yeah, I'll come to that question. Akash, if you can elaborate on your question, then it will be easier for me to answer. How will I understand that the market is overvalued or not by using technical process? Okay, overvalued, undervalued is more of a fundamental concept. It can be used under technicals also. There are tools in which we can understand that. Under technicals, we have these concepts of overbought and oversold. Okay, now let me show you. Let's say this is Reliance Industries and a very simple technical indicator. Let's say a momentum indicator like relative strength index. These are the indicators and oscillators which are covered in I think the 7th or the 8th session. So if I just plot this, I'm not going to go in detail with the RSI, but the simple thing is the green line which you see is just an indicator oscillator, and the theory says that every time it shoots above the 70 mark, which is this dotted gray line, is kind of overbought. That's the degree of buying has been much higher than the degree of selling. So there are such various indicators and oscillators on the technicals. At times they go right, bang, right, and at times they probably will not go so right. So it comes down, it boils down to the chart reading capability, understanding of the chartist. Whether the prices still have some upside left or this is the top one. So it will definitely come with more understanding of the theory and practice. That's my answer. To understand overvalued, undervalued, I can share my little experience of what one can do is, there's a little advanced technique, is what one can do is start plotting or tracking spread charts or ratio charts, let's say Nifty on a base of the dollar or a Nifty on a base of gold, especially gold, because gold is a very good store of value asset class. So when you see and spot those, plot those charts, you can find out whether the Nifty is undervalued or overvalued in terms of gold or the dollar. Okay, I have another question. How to determine the reversal point of a stock whose normally stays in its average price range but is suddenly going down and following the downtrend? Adani Power. Okay, that's good because I have an example. Let's say Adani Power. Now I try to open the chart of Adani Power, and the question is, how do we know when it will reverse? Well, the true fact is, to a lot of extent, no one knows where it will reverse, but we can align a degree of probability that it probably will reverse here, and it has a chance of 50, and down a little it has a much higher chance to reverse. So the idea here is not to make any assumptions. Please do not make any assumptions. The fact that the stock has fallen 14% in the last 1 week means that it will reverse. It may reverse, it may not reverse. But our work is to analyze the past, that is the chart that we have in front of us. And clearly you can see that, when the last move up of Adani happened, it was at the lows of 46, 46 and a half. That was the May 2014. And it's actually approaching that level of 46, 40, 46 and a half. We would keep a very close watch on this range. It's been falling very sharply for consecutive 6 days. The indicators have gone to be oversold. Remember some time back I was saying above 70 it is overbought. Down below 30, which is the case of over here, you see that this is the zone where it is oversold. It is entering the oversold. The green line has gone to 26.6. So the possibility of Adani Power finding some buying or the degree of selling easing off is much higher here. So we have to keep our eyes open for the ease off of the selling. Markets which are selling like this, I'll zoom in and share my little experience. 3 days of selling, sharp selling to closing towards the low of the bar, hitting oversold territories where it's going previous lows. High chances that the stock will probably try to bottom out. The bottom out process happens like this. The selling has to ease off first. The selling will stop first. The last seller will sell. Then only the buyer will come and then the move will happen. The first degree of buying probably comes from the guys who will cover their shorts and then the move. So to answer your question, especially the case of Adani Power, it is oversold. It is hitting previous strong lows which are supports. We know that this is the range where the stock can bottom out. So if we close watch on it, it gives you the first sign that it's bottom out. You can press in a trade in it. Okay, how much equity research help technical analysis? Okay, I will take this question and reframe it if I understand it right. Shanti Brotho, is the fact that you're saying how much fundamental analysis will help technical analysis. Now, understanding the basic fundamental analysis definitely helps. Yeah, understanding the basic fundamentals of a company or the market definitely helps. Technical analysis definitely will help a great deal to time it. I have worked with colleagues and I know people in the market who are fundamental in nature, but they use technicals to time it. It's a nice mix, but let's not make it. What happens is your fundamentals may tell you that the stock is really undervalued and one should buy, but the price can keep on coming down. The price can keep on coming cheaper and cheaper, or the other side. So to some extent I would say yes, it helps, but let's not extend it. Anything above the necessary can actually spoil things. So when you get contradictory signs from your fundamental equity research and technical research, that's where you will get a little bit puzzled. Fundamentals, as I said, is more about the company. Technicals is more about the stock and the demand and supply. It's more of a timing tool. When they merge, you get the best of trades. Okay, Akash has asked another question. Before investing in stocks, technically, what should we see? Okay, simple. You should have your own universe of stocks that you should trade into and not just any stock. So let's say, Akash, that I'm making a small little assumption that you're tracking only the Nifty 50 stocks, or let's say only the Nifty, that you're a Nifty trader. So before investing in Nifty, technically what you should see. 2 things or 3 things that goes into it. First is never try and swim against the trade or the trend of Nifty. Now I'll open the Nifty chart for you. For this I'll do the C, and now in case of the Nifty spot, what I'll do is I'll open the Nifty future chart for you. So I'll drop down to DNC derivatives. Over here I'll key on Nifty and enter. It will give me Nifty future charts. So let's say September and say I have the chart of Nifty here. So what you should technically see is what is the trend of the market, and there are various ways to understand, analyze, calculate the trend of the market. Now let's say you have an uptrend. According to your analysis, the Nifty is in an uptrend. what you should do is there are two ways to trade that. Either you can trade a breakout, that is buy high and sell higher, or the other way is to wait for a fall or a pullback where you can probably buy at a little cheaper price. Now there are various ways to do that. That is essentially a typical swing trade. There are various systems, various rules in which we can trade those things, and those goes into the rules that trade into the market. But essentially there are two ways. You trade breakouts, that is you wait for the price to move above a certain high, etc., or a certain range. That's trading a breakout. That is more trend following in nature. Buy high, expectation that you will be selling higher. The other is a contrarian, where it's going just higher and you want to go contrarian to that. Contrarian is a very good trade if you can pick it right, but my experience, contrarian traders do get that hang of it after a certain degree of experience in the market. The other way is you have the trend, you have the breakout, but you wait for a little dip down and then you buy. Okay, right. So we've been talking about this line charts and graphs. Candlesticks have shown you. Log linear, this is one simple thing I'll just talk about. You see, when you open any chart on the right hand side, that is the vertical axis. It can be log chart or a linear chart. LNR, LOG. Okay. LNR. Now let's say I open a chart for you. Let's say I open a sugar chart for you. Let's say Balrampur chain. Okay. And this is the daily chart of Balrampur chain. Now this is the linear chart LNR, this is a log chart. Not much of a difference apart from the fact that when I'm doing it log chart, the overall chart is drifting a bit on the upside. That's all right. Now if I open the monthly chart, now this is a monthly chart. The difference between monthly and daily is daily has limited data. It's just showing data from 2013 October till now. When I do monthly, it is showing all the data from all the way from 1995. Now if I change this axis from log to linear, just notice what happens to the chart. It just becomes a completely different chart altogether. The linear chart looks like this. The log chart looks completely different. So what's happening? What's happening is in the linear chart, the vertical axis, the linear chart, the vertical axis 10, 20, 30 are the fixed units of 10 points in this case. Yeah. But in log chart, you see that they are the fixed percentages. And as you move forward, as you move up, the gap diminishes. You see the gap between 10 and 20 and see the gap between 170 and 100. Much lesser compared to this. So bottom line, when you're looking into a short-term chart, let's say a daily chart, where you have around 200 bars, candles, a log linear will not make much of a difference. You can look into log, you can look into it. Doesn't much difference. But if you're looking into a long-term chart, a multi-year chart, where there are 10 years, 7 years of data, then it makes sense to look into the log chart, because a log chart shows you the highs and the lows in a perfect manner. So if you focus on these areas where you have the trading range, if I do the linear, it's completely gone. You can't make out in a linear chart. So this was something important which I thought I'll share with you, the difference between the log and linear. Okay, so Satyendra has a question from where an investor could do a fundamental analysis before buying any stock. Okay, now fundamental analysis,
That is the company details, profit and loss, etc. Most of the companies tries to be as transparent as possible, so you will find their details on their websites, or nsindia.com, bsindia.com. They also share a lot of details about the market. You can ask your stockbroker if you're not a broker yourself. Most of the reputed stockbrokers collect fundamental state data. They have a team which analyze the data. So you can ask for the raw data from them. They'll be more than happy to share it with you. And that's how you can do your fundamental analysis. Okay.
right. So guys, any questions so far? Then I can just talk a little bit about the Dow theory that we had, which is there, the basic uptrend and a downtrend definitions, series of higher highs and higher lows. Is what is a downtrend? Is an uptrend. Sorry, beg your pardon. The opposite of that gives you a downtrend. That is a basic Dow theory based on which you can define a trend. So going back to a chart, something like this. If I make it into a line chart, yeah. So when you have a series on uptrend and a higher highs, you have a series of higher highs, a higher high, but you don't have a higher low yet. So once you have a higher low, that is if prices start to go up from here, you have a series of higher highs and higher lows. That's when you have a defined uptrend. See over here, in case of when the market was coming down, makes a lower high, and when this low was breached over here, it makes a lower low. So the erstwhile uptrend has been reversed. All right. Akash, there are lots of news coming on penny stocks scams. So during an IPO of these penny stocks, the fundamentals are good, but after a certain time period, these company are vanished. So from an investor side, what should we do? Well, you should do a lot of due diligence. You should, before you put into an IPO, to a lot of extent within your capacity, you should try and analyze the company, and obviously have a max pain in your mind. Let's say if you fall into one of these stocks where post the IPO or after a certain time after the IPO it's not panning out like the way it was being said or you anticipated, you should have a max pain anticipation in your mind that what is your risk to this. That's the difference between the primary market and the secondary market. You see, technical analysis is everything about the secondary market. Things, instruments, financial assets which are listed, which has a decent liquidity, which have a track record, that is the past history and volumes, and then we can analyze that. But when you are in the primary market and you want to invest into an IPO, which does not have a history of demand and supply, technicals definitely would not come into the picture at all. So that's where your fundamental skills or your company analysis skills comes into the picture. There are good experiences of IPOs and obviously there are bad experiences of IPO also. So yes, you have to do a lot of due diligence, and I would say it's more psychological in nature, so you should have a drawdown or a maximum pain in your mind. That is if you go wrong. Okay, Sudhanshu is asking me, can you explain your technical views of Datsun Labs and VIP Industries? Okay, I would be very happy to share my views, but Sudhanshu, I will probably request you to probably drop me an email or call me later so that we can talk about the stocks. I'll as we have restricted time now, I will be more keen on discussing about the contents of the subject. Okay. Which time frequency is better to follow for intraday? Okay, Mr. Rao. This is a nice question. I would share my own experience. So what one should do is like this. Let's say you're a Nifty trader, okay? And for intraday, my sense is the 5-minute chart works really well. This is a 5-minute chart intraday. Okay. Another thing, Mr. Rao, should keep in mind that there are 375 minutes of trade in a market every day. So if you divide by 5, you're around 75 bars to pay out. So my preference is a 5-minute or the 10-minute. It gives you around 2 to 3 trades. Try not to take any trades post the 3 o'clock or 3:10 because you have very limited time for the trade to play out in your favor or against you. Also try not to take the first 5-10 minutes because that's when the maximum noise. When I say noise, the volatility, the deviation from the average price happens in the first 5-10 minutes. I generally don't trade the 5-10 minutes in the opening and the last 5-10 minutes. So after the 5-10 minutes, when the price stabilizes a bit, you can implement your strategies and trade. My suggestion would be the 5-minute or the 10-minute time frame for intraday trades. Before that, look into the daily charts every day. If they're oversold, overbought, then those are very nice candidates for the next day trade. All right. Yeah, so these are the basics about the Dow theory for the primary, secondary, and the minor trend. It's the long-term, short-term, medium-term trends. The accumulation phase, the consolidatory phase, distributory. This is a nice one. So you can have a chart like this. This is an accumulation phase where it's more in terms of time that the market is trading. It goes on to makes up into consolidation also in this case. This is the Stride Industries, CR5 fall, Starlight Industries, sorry, Northwest Starlight Industries. This is Naban Offshore. These are various examples which are given on the videos on the website. I'll request you to go through them. The various examples of distribution and accumulation on the various charts across the sectors also. This is one interesting thing I think those who are positional traders would like to watch. That is the averages not confirming each other. This plays out fairly well because I've seen this happen many a times where the large caps, you see the Sensex is reflecting the large cap over here. The BSE mid cap is reflecting the mid caps of the market. It's making a higher high, that is in terms of Dow theory, it's continuing its uptrend. On the Sensex, it's not making an uptrend. So you have an indication from the large cap section of the market that it's tiring out. Same and opposite thing happens on the downside also. The quality movement obviously starts when the large cap sees who's buying or selling. That's one important tenet of the Dow theory. Criticisms of Dow theory, which I mentioned in my video, saying that the signals are too late. Yes, by the time it becomes a higher high, higher low, or a sequence of a lower high and a lower low, a lot of price action has already taken place. So that's one thing. And obviously Dow theory to a lot of extent cannot forecast whether trend reversal will take place. Sorry. So moving forward, a little bit about trend lines, support, resistance. I'll just show you on the chart how to draw trend lines in this software. So if you right click, box comes with a lot of information. These are the tools: trend line, channel, price retracements. Now T is the hotkey for that. So if you just type on T, pencil like thing comes. Say if you want to draw this trend line, you come to this bar or candle, you do L, it will take you to the low of the candle. If you do H, it will take you to the high of the candle. Do L once, enter, move to the right, and you do L again, enter, you can choose a color, and then you have a trend line. Okay. Okay. Rohit is asking me a question. Is 9:15 to 9:30 a good time to have an intraday position? Well, Rohit, well, for intraday traders, it's like this. They don't take much decision at the start of the day. This is how it works. They generally do their homework before the market opens. So let's say they have an idea that, okay, we are going to buy into the Nifty or sell into the market. The 9:15 to 9:20, 9:25 is where the maximum of the orders in the system gets triggered, executed. So you will see gap ups, gap downs, or spike ups in the first 5-10 minutes. I would rather say that after you've done your homework, that these are my stocks I want to do intraday, let the first at least 5 minutes pass on. You would not like to get stopped out or whipsawed due to big trades taking in the first 5 minutes. So, let the 5-10 minutes, let go of it, let the noise settle down, and then you, according to your homework, you can start taking those trades. Satyendra is asking me, how can I contact you after this webinar? Okay. And Rohit is asking me how to come out of a stock where circuit has done. Okay, I'll answer those. Well, how to contact me? At the end slide, I'll share some of my details in terms of email ID. You can obviously contact Elon Markets, Vinita, can get in touch with me, but I'll also share my email. You can reach me on my email or my call. I live in Calcutta currently, so you can give me a call also. How to come out of stock where circuit has started? Rohit, I'll be very happy if those circuits are in your favor. That is, if you've gone long and circuit up, you must be smiling and sitting quiet. But yeah, if it's on the other side, you'll be painful. So the circuits is something that we see predominantly in the penny stocks. If you're trading the penny stocks, it's a trade-off like anything in life. It comes with a price. So try to take stay there in the system at the beginning of the trade where you would like to exit or enter. If it happens, it's your luck. If it doesn't happen, then you just have to just bear it and go through it. There's not much you can do. But yes, fill in your position before market. Okay, Mr. Mohanto is asking me, is open interest increase or decrease any impact on technical analysis judgment? Yeah, open interest and volumes is something that I've covered also in this session of our webinar. Like it does play a role, volume and open interest. The basic understanding, I'll just show you. I have a table here which is part of the videos. which will show you the basic understanding of open interest, and is a volume price matrix, and this is the open interest price matrix. So essentially, when it's a rising open interest, the interest of the market is open. They're not closing it, and the prices are going up. The expectation is that it will probably go further up, so it's strongly bullish. The vice versa is strongly bearish. When if the prices are coming down, let's say we saw the example of gunpowder, stock is down 14%. The price has been coming down, and let's say the open interest is going up. So the interest of the market is still open, and if the interest is still open and the price is falling, it's very obvious that the interest is on the downside, so it's strongly bearish. There are some divergences to this that happens. I'll probably look into more into possible market top and market bottom. That is the fact when you have a rising price but the open interest is falling. It's the diverging thing. This is a confirming thing where it's rising and it's also rising. This is a diverging thing. Now the diverging gives a much clearer indication that yes, the price is going up, but the interest of the market is coming off. That is, people are taking off profits from the market. So that's possible a market top. Now this leads to a nice reversal trade where the risk reward is in your favor, where the stop losses are near and the possibility on the downside or on the upside is favorable. So yes, yeah, open interest to some extent, a lot of extent actually pays off, but you have to keep in mind that open interest is only for the futures market. It is for those stocks which are traded in the futures and options market. Right. We also would talk a bit about the reversal patterns. If you have any questions on the reversal patterns, I'll be very happy about the classical reversal patterns like the head and shoulders and the inverse head and shoulders. Earlier when I started, this exactly happens with most of the guys who start into technical analysis. They start to see a lot of patterns. I would recommend one thing. That is, let's say this is the chart of Nifty, and you might probably be seeing a double top here, somewhere here. Always wait for the confirmation. So what I'm trying to say is, let's say you're somewhere here at this juncture. Yeah, you're at this juncture, and you see the last high was close to 7,800. The current high is also close to 7,800, 7,836. Possibility of a double top. If it breaks this, then the market will fall. Again, don't make any assumptions, especially in the market and with your life. So the confirmation of any pattern that's like there in the theory should wait for the breakdown. That is a pattern to confirm. Once the pattern is confirmed, you'll get enough downside or upside to play out with. But don't preempt the pattern. Don't start to look into a pattern which is not there. And at times I would suggest that the basic line chart, which most of us ignore nowadays, I sense has a lot of information. That is just the closing price, especially in terms of patterns. So it's over here, if you can see that the market is coming off, makes higher high and kicks off, right? But if you just look into the line chart, you can see a nice, simple double bottom in place. Double bottoms and double tops are something which I have found very common in our Indian equity markets, and they play out fairly well. So once this is confirmed, you have most of the move to play out with. So try not to preempt it. Try not to anticipate a move that is not happening yet. That's about the double tops and double bottoms that we discussed. If it moves another the third time, that's your triple top, triple bottom. Essentially, the market is taking too much time. In any classical pattern, be it reversal or continuation, in reversals we have spoken about head and shoulders, double tops, triple tops. In continuation, we'll be talking about those triangles, wedges, pennants. Always and always in terms of trading patterns, wait for confirmations. So, yeah, this is an example of the Bajaj Auto head and shoulder. Always wait for the breakdown. Always wait for the confirmation to come. This is the head and shoulder bottom, where you have the shoulder, the head and shoulder. The breakout comes to the test out the neckline. It continues to find support on the neckline and moves up further. That's what it does. My experience with these patterns, and there are a few good books on patterns also. I think there's one excellent book by Thomas Bulkowski. He's done a lot of work on patterns. Is the fact that yes, they to a lot of degree has some authenticity and they do pan out 60 to 70% of the time. But like everything under the sun and in the markets, be prepared if the pattern fails. There's always work with the stop loss. This is a double top, this is a double bottom. Bank of Baroda sometime back. Continuation patterns essentially are in a hurry. Triangles are the best of ones, the symmetric ascending and descending triangles. I'll show you some examples. This is how it looks like. Wait for the breakout. So essentially, these are all reactive technical analysis. The classical technical analysis, which was written in the first 50 years, from 1900 to 1950, 1960, was more reactive in nature, that is trading for breakouts. This is what an HDFC 60-minute chart or an IDBI bank chart does. The ascending triangle is another very good continuation pattern. The descending triangle, the only difference between ascending and descending is one has a horizontal and one is rising, the other one is horizontal, the other is falling. So that's a descending. Wedges, both of the lines are plane. In this case, both the lines are rising. That's a rising wedge, or an ending diagonal that we call in the Elliott principle, is the fact that the markets are making a higher high and a higher low, but you have a pattern on the long-term charts which lead to vicious falls. This is the breakdown that we have had. Most of these patterns, when they form in long-term charts, like a daily chart or a weekly chart, be very much prepared for a vicious move on the other side. This is chart of Maruti. Historical patterns. Flags and pennants are the best of continuation patterns. You find them in the 60-minute, 30-minute charts all the time. Very good continuation patterns to trade. Essentially, flags are like a small parallelogram, halt in prices before the prices turn up again. Pennants are the smaller versions of symmetrical triangles. Symmetrical triangle may take three weeks to over a month and a half to form. Pennants are more short-term in nature, quick formations of price, breakouts. There's the other rectangle, the box pattern, price within a floor and a ceiling, wait for a breakout to trade, works very well. Within the pattern one can trade also, shorting the highs and buying the lows with very strict stop losses towards a little higher or lower side of the boundary. All right. So I'll just drill down to the, So if you want to contact or email me, feel free to at my Gmail ID. You can call me also. Do mention about yourself and that you had been a participant in our webinar. I'll be very happy to help you. Preferably post-market hours, that is the post 3:30 p.m. post Indian market 50 hours. Any doubts? I'd be happy to answer you. Okay. All right. I think Vinith, we are good. I'm really grateful. Thank you everyone for joining me today. Hopefully the next webinar would be sometime mid next month.
Thank you, sir.
Yeah. Okay. Thank you everybody for joining. Thanks a lot. Take care.